Ray Dalio advises, do this now as America enters catastrophic collapse. Raymond T. Dalio is the founder of Bridgewater Associates, the biggest hedge fund in the world. With $140 billion under management, the company manages assets for institutional clients such as pension funds, endowments, foundations, foreign governments, and central banks. He has researched the last 500 years of economic history and has warned and shared his thoughts on the economy and markets as we're all headed into a period of 10 to 20 years which will be very turbulent. He goes on to describe what he sees happening, provides a detailed explanation of how the economy functions, what often occurs during a crisis like the one we are currently experiencing, and what he expects asset owners to do to improve their likelihood of success. And much like his famous note to Bridgewater employees, it's filled with both opportunities and dire warnings. Hello and welcome to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. Before we start, make sure to leave a like, subscribe, and comment below if you enjoyed watching this video, and turn on the notification bell to keep posted. Now, without further ado, let's head on to the video. An economy is not a difficult concept to understand. There are just many moving parts. But in essence, there is a transaction in which someone purchases a product, a service, or financial assets. One may use cash or credit to make such a transaction. When you pay with cash, the transaction is completed. However, when you use credit, you incur a liability, because credit, like a debt, is a commitment to deliver money. Therefore, you must come up with the funds. So there is a basic transaction in spending. In other words, the total amount of cash plus credit used to purchase a commodity or service. Then, there is the product itself, whether it be a vehicle, a bag of corn, a stock, or a bond. In general, consumer spending is the most reliable measure of demand. According to Ray Dalio, it is incorrect to define demand in terms of the quantity of goods in classical economics. When making a transaction, cash or credit is exchanged for the item being bought. From here on out, where we go is through a credit cycle. Credit may be created, but contrary to popular belief, it is not created by velocity. Moreover, it can be made out of nothing. If you go into a store and promise to pay later, you've generated credit. It will be considered a production item and will be included in GDP. That is what we refer to as a credit cycle. If you do not owe a lot of debt, you may be able to borrow money. Consider the scenario where you make $100,000 yearly and have no debt. From here on out, you may borrow $10,000 per year and spend $110,000. The $110,000 you're spending is someone else's $110,000 income. Therefore, it has a good impact, and you go through a cycle that really reinforces itself. According to Ray Dalio, throughout that cycle, debt increases more quickly than income. However, the debt-to-income ratio cannot continue to grow faster than that. Thus, a debt cycle occurs. What makes it come to a stop? Dalio argues that historically, when interest rates are lowered, debt is created and has three positive impacts. If interest rates are excessively high, they must be reduced. If interest rates are reduced, debt servicing becomes less of a financial burden. It has the impact of making goods less expensive to purchase on credit because the monthly payments are lower. It affects the present value of assets. Therefore, if you reduce interest rates and you own anything that generates a cash flow, such as real estate or another business, you will see an increase in the value of such assets due to the present value effect. This creates money and makes it possible to borrow more. So, according to Dalio, when you reach a point where you can no longer decrease interest rates, say when they hit zero, that phase of the cycle ends. So you then proceed to a deleveraging. According to Dalio, deleveraging means that you can no longer increase debt in relation to income. And when you're unable to accomplish this, the cycle starts to go the other way. According to Dalio, if individuals aren't very adept at incrementally predicting what the consequences on demand are, the marginal change will have a detrimental impact on growth. Deleveraging, in Dalio's perspective, is when income and spending combine to start a downward spiral that eventually leads to the onset of a depression. A depression is a stage of deleveraging where austerity measures and debt restructuring are combined. Because if you have an excessive amount of debt to service, you must take action. There are, however, a finite amount of things you can do. According to Dalio, you may either transfer the debt or combine austerity measures with debt restructurings. A debt restructuring means you reduce your debt in a certain way or manner. Because of the profits you made, you were able to reduce your debt to a level that you could manage. Restructuring may occur in one of three ways. You can write down the debt, say, write it down in half. The issue is that another man's assets are another man's debts. Therefore, cutting it in half has a significant negative impact on wealth. As a result, you are unable to borrow money. Therefore, restructuring becomes an issue. You might restructure it by writing it down or, in another way, by lengthening the payments or forcibly reducing the interest rate. However, in order to service that sort of debt, which is a laborious process, you must somehow get payments in line with the cash flows you are generating. On the other hand, Dalio says that depression is the stage of deleveraging when austerity and writing down debts happen together. The third strategy for dealing with restructuring is to print money. So, in deleveraging, they ultimately print money. It is included in the mix. The finest ways of deleveraging are those that strike the correct balance between these four factors: a certain level of wealth transfer, a certain amount of austerity, a certain amount of debt write down, and a certain amount of money printing. In the end, Dalio contends that you must reduce your debt to income ratio in order to achieve equilibrium of the four factors. While the production of money is inflationary, debt write downs and austerity measures are deflationary. If you can reach the right balance between those factors, you will have accomplished what Dalio refers to as a beautiful deleveraging. When you look at the deleveraging and the debt to income ratios and say, how have they come down over time, like the ones that occurred in the United States during the Great Depression or England after World War II? In all of these circumstances, they were able to come down by combining the four described factors. According to Dalio, the primary reason they came down is that there is enough money being printed. Dalio went on to explain that because there is a cost associated with debt servicing when you have a particular level of debt, the nominal growth rate in GDP must be greater than the nominal interest rate. Additionally, if the interest rate on the debt is higher than the nominal GDP rate, it will compound and have a negative effect unless you continue to make cuts. Therefore, according to Dalio, the most crucial factor in deleveraging, such as what the United States is currently doing, is having enough money printed to achieve a nominal growth rate that is higher than the nominal interest over time. On the other hand, according to Dalio, the mistake of monetary policy is that it targets both growth and inflation. Inflation and growth are crucial, but what they actually do is increase debt. Therefore, as per Dalio, it must focus on debt growth relative to income growth and growth relative to sustainability. Additionally, buying financial assets frequently involves a significant increase in debt, which is a classic bubble. Thus, for example, the year 2007 or similar times have witnessed significant increases in debt, accumulating for purchasing financial assets. These financial assets were unable to pay their debts, causing a bubble. Dalio claims that this is what led to the 1929 bubble, the bubble in Japan, the bubbles in 1989, 1990, and 2007, and among others. Hi, we hope that watching this video was interesting and that you learned something valuable. If you liked it, please hit the notification button, like it, subscribe, and watch more of our videos. Also, don't forget to share your comments in the comment section below. This is Finance Sense, assisting you in staying current on all the most recent changes in the financial and economic landscapes. Until next time!